Inflation hit its lowest annual rate in 2 years in May, but consumers are still grappling with the aftermath of price hikes from the 8.9% peak hit last June. Yahoo Finance's Rick Newman joins us now with some insight. Rick, good morning.
Hey guys. Yeah, I mean, we talk about this every month in excruciating detail. What's the change from month to month? What's the change year over year? I think we kind of lose track sometimes of where do consumers actually stand on inflation since it actually became a problem, which is basically during the last 2 years. And we're definitely seeing a positive trend. I mean, the rate of inflation is going down, but I think the problem a lot of consumers are grappling with is that the price hikes we've seen over the last 2 years are still there. Most things that have gone up in price have not gone back down in price, back to what you might call the 2021 baseline. And overall inflation during the last 2 years has outpaced growth in earnings. So people have been paying more and paying more for the stuff that really matters, including food, housing, and energy. Those costs, if you look at it over a 2-year period, those costs are up considerably more than earnings are up. So I think that is one of the reasons that even though inflation is definitely improving, consumers are in a very gloomy mood. I mean, some confidence indexes show consumer attitudes are basically at recessionary levels. And I think it's because people have lost purchasing power and they have not regained it. So the thing that will actually put people in a better mood is if we actually see prices coming down in a notable way and they start to regain some of the purchasing power they've lost over the last 2 years.
Right. And so where particularly do you believe that the Fed may be evaluating wages within their decision as well, even as they pair where prices are right now, where real wages for employees and those who are labor force participants and also consumers, where that's going?
I mean, that's a conundrum at the Fed because the Fed, I mean, strangely, the Fed actually wants to slow wage growth. And part of the reason is that this concerns about the so-called wage price spiral. And the theory there is that if wages go up, then people are going to be willing to pay more for stuff, or they might buy more stuff. So demand goes up, and rising wages actually generate more inflation instead of curing inflation. So, we forgot all these lessons because we hadn't had inflation since the early 1980s. But it's a very delicate balance between prices and wages, and that when that gets thrown out of whack, as it has for the last 2 years, it's really hard to get it back into balance. So that is everything the Fed's grappling with, and that's why we've been talking so much about will there be a hard landing, which is a recession. The Fed raises too fast or by too much, and it hurts consumers more than necessary. I think maybe by this time next year we might have some clues, but it's still murky.
All right. Yahoo Finance's own Rick Newman. Your shirt, Rick, today is serving dot plot realness right now, I'll say. So we'll continue to see exactly where that dot plot comes in.
I live and breathe the Fed, baby.
We know it. Thanks so much, Rick.
Bye, guys.